It's earnings season. There are four times a year that equity traders really capitalize on individual stock movements. It's really these four times a year where volatility is heightened for individual names, and names will not necessarily be following the general market. As a rule, you should always keep in mind approximately 84 to 87% of all stocks follow the direction of the general market. However, that doesn't apply during earnings season. During earnings season, you're getting catalysts, fundamental catalysts that are propelling stocks either upwards or downwards. Before we start, I must put this disclaimer out there, and we're going to say it a few times throughout the video. If you are not an investor and you're just a trader, do not, under any circumstances, take stock into earnings. These are binary events by which you cannot control risk. As the great Peter Lynch is quoted famously as saying, they're companies, they're not lotto tickets. So you need to respect what you're doing. If you're just trying to bet on a company earnings, you're probably going to get hurt, and you're going to get hurt really badly. Do not, under any circumstances, take stock into earnings if you're a short-term trader. If you're an investor, it's a different story. It doesn't matter. But if you're a trader, do not, under any circumstance, take stock into earnings. So we got that disclaimer out of the way. Let's continue. Okay. Now, one of the things you have to look at when you're preparing for your individual stocks, whatever stock it is that you're looking at, it's very important to see how far these stocks have moved. A lot of these stocks, and I purposely have JP Morgan up for a reason, have had really big moves. JP Morgan has basically moved from the lows in April, from when Q1 earnings came out of 202. It got all the way up to 291. So it basically moved like 90, almost $100 in one quarter. So keep in mind that there could be a lot of events where it's buy the rumor, sell the news, like we had here today, where it was basically just buy the rumor. Now, granted, the market was going up. And as I said earlier, 84 to 87% of all stocks follow the direction of the broad market, except during earnings season is really more very catalyst driven for individual stocks, because again, fundamental news is coming out. How are these companies doing financially? What are their earnings looking like? What is their guidance? Where do they see things going? What was their revenue? So these are fundamental shifts in the business. Remember, it's a stock. It's not a lotto ticket. These are companies. So a lot of things can change based off of what these companies say. Now, in the case of JP Morgan, the earnings were good, but at the end of the day, it doesn't matter because the stock had such a huge run up. It was basically buy the rumor, sell the news. So in this case, you could have times where a stock gaps open like it did in JP Morgan's case, and it sold off all day. Now, did it really go anywhere? No. But the bottom line is that it was pretty much being priced in the entire time. Okay. Let's look at another one. Just quickly, just for an example. Wells Fargo. Then we're going to get to some technical. Wells Fargo. So what did Wells Fargo get hit on? So in banking, there's something called net interest income. Net interest income is basically the difference between interest earned on loans versus interest paid. For example, think CD savings accounts. Banks really are judged on this net interest income or net interest margin. The wider it is, the more money the bank is making. The narrower it is, the less money the bank is making. Right? It's a very big metric in banking. It's not a metric in anything else. It's bank really where that metric really comes into play. Okay. You can read the conference calls. I'm not going to bore you with it, but there was a little bit of a disappointment in it. However, if you really look at it and you think about where the stock was, let's just say a month ago, we had a pretty decent run up for a $78 stock. We had a pretty decent run up from 72 up to 84. Take a little profits on a gap down. Were the earnings a disaster? No, but you could have situations like this. So you really need to manage expectations and not assume that every single stock is going to knock it out of the park and the stock is just going to go flying. That's just not the way earnings season works. For example, I'm going through a couple. Citi was one that rewarded today. Okay. But at the same time, it really didn't go far. The distance it traveled from, let's say, these recent highs at 88 to 90, really, what it really moved? $2, $3? It didn't really move. Again, why? The main reason is look at this move from Q1 all the way to Q2. Now, granted, you had Liberation Day, you had a bunch of things that happened here. Fine. But if you look even in the past month, some of these stocks have had such huge monster moves that a lot of this earnings hour, so to speak, that juice has already been baked in. So you could get buy the rumor, sell the news. The reason why I bring this up is just to keep your expectations in check. Another thing that you should do, and it's a tip that you could see, is you want to figure out how far a stock can actually move. So I'm going to use tomorrow. I'm going to use Goldman is reporting tomorrow. I'm going to pull that up. Okay. The expected move for Goldman tomorrow is $21.75 in either direction. That's the expected move according to the option markets, which means its expected range for tomorrow, based off of the close of 72.51, would be 74.26 by 680.76. That's the expected move. So let's just plot this out. So 720, what is this over here? This is 7. So basically, let's just say here to about here. This is your expected range for Goldman for tomorrow, based off of the option market. Now, does that mean it has to travel that range? No, it doesn't mean that at all. It just gives you a way to manage expectations of what could actually happen. Now, that doesn't mean if it gets up here, short it, or if it gets down here, buy it. That's not what it means. All it's telling you is what is the expected range of where this thing can go based off of where the option market's pricing it. Okay. So let's just get this out of the way a second. So now we have two different ways of looking at things. We have the option market for pricing the expected range, and we have the buy the rumor, sell the news type of scenario. So now let's go to a third scenario, a little bit of a technical scenario. Let's say, for example, you want to buy Netflix. Netflix reports on Thursday. Okay. So Netflix's expected move, just so you should know for yourselves, is right now $78.90. So using today's settle, so that would be 1260.27, and the expected move of $78.90 means the expected move is $1,339.17 at the high end by 1181.37 on the low end. So let's just plot that out just for fun. Okay. So 1339.17, and I'm just assuming, obviously they're not reporting today, but let's just assume that let's just assume they're reporting tomorrow morning before the bell. Okay. Based off of where the stock is right now, this is the expected move according to the option market. Okay. Obviously it's not 100%, but it gives you a little bit of an idea of what range the market's expecting. Okay. Fine. So how would you play this? Here comes our third scenario. So you look for areas where, for example, breakouts make sense or breakdowns make sense. Now, I would not advise trading after hours unless you are extremely experienced. In after hours trading, there is no market orders. It's only limits. So number one, you may not get a fill. And number two, you could get caught because you can't get out. Because again, it's only limits. Limits mean that if you put in an order to buy, someone actually has to sell it to you. If you put out an order to sell, someone actually has to buy it from you. Also, because liquidity is not there, because again, it's after hours, you could have, let's just say, I'll make up a stupid number, an order for 1,000 shares, and you can only get filled on, let's say, 2. And you're stuck with the 998 shares. You're trapped. So this after hours trading, you have to be really, really careful and really experienced. Okay. Like I said, these are not lotto tickets, and you could get caught and you could get hurt. So you really have to be very extremely careful. Okay. I'm going to bring in that disclaimer one more time. At all costs, if you are a trader and not an investor, do not under any circumstances take stock into earnings. Again, if you're a trader and not an investor, if you're an investor, it's irrelevant. If you're a trader, under no circumstance should you be taking stock into a binary event. That's what earnings are. They're a binary event. If you feel like you must do it through options, why? Because risk is premium paid. Okay? Fine. Let's say, for example, forget about what the name of this is. You wanted to get long this stock on earnings, but you don't really want to buy it over here because there's not really any juice over here. Is it really meaningful to buy, let's say, over here where it's coinciding with these lows? So there's a couple of ways to do it. I wouldn't do a trend line because it's a little bit convoluted. I guess you could go from this high over here and go this way. But the problem is that really, if you buy above this, you're buying into this cluster. So I don't think that makes much sense. I would tell you, you probably would be looking to buy against these recent highs over here. Once it takes this out, that makes more sense. So if you're getting in over here, the first question you have to ask yourself is, where am I getting out if I'm long? If I'm buying these highs, where am I actually wrong? Not where am I losing too much money, but where am I actually wrong? If you're going to buy this, you're going to have to use this as your out. That's your out right here. You're basically playing this box a little. If this gets taken out, your anticipation is that the stock should keep going this way. So reality, where are you really wrong? Because you're really playing a range. So if you're buying the top of the range, a breakout of the top of the range, your stop's got to go at the bottom of the range because that's where you're wrong. If you put your stop in here, let's say, for example, this little area over here, you're not wrong. You're getting stuck in the range. Okay. So know what you're trading and what you're buying or what you're selling. So let's say, for example, you wanted to short. Let's just use that. Where would you short? You're not going to short over here. You got to short this, a break of here. And it's the same concept. So if you're selling this, where do you think your stop has got to go? It's got to go up here. Why? Because again, you're playing a break of the range. Okay. Let's just do a couple more just to get a couple on the books. Let's see who else is reporting this week. So we have tomorrow. Again, we've got Goldman's reporting, Bank of America's reporting. Let's look at Bank of America's. Okay. Let's say Bank of America. Okay. This is actually a good one. Let's say, for example, Bank of America has been pulling in a little bit. Where would you think that Bank of America may potentially find some support where you could buy it? Usually in the world of moving averages, if it breaks the 8 and 21 day, then you can start to nibble at the 50 and see if that holds. Usually the 50 holds. In order for us to get to 200, a lot of things need to go wrong and go wrong really quickly and badly. These banks are not reporting disasters, because of which you're not going to get moves to the 200. I just don't see it happening. The only way it happens, again, is not just earnings, but something else. So you probably get some bounces off the 50. However, you should not be just assuming, okay, I'm just going to put out limit orders at the 50 and let the market slam into me. It also has to make sense. So if you look over here, you got a little bit of some support, horizontal support going around over here, basically in this kind of area, which really lines up a little bit better. You could look for a move to buy at 45. That would be one way if you wanted to buy. Again, if you're playing the moving average game, then what do you need? You're going to need the market. If you're buying the 50, you need the market to hold the 50. Not throughout the day, but at the end of the day, by the close, markets had to have held the 50. If it didn't hold the 50, then get out. There's no reason. It's not working. Okay. That's another way you could do this. However, when you look at, let's say, for example, this specific stock, we broke the 8-day, we broke the 21-day, they're curling down. This really isn't so much a law. But let's say, for example, they knock it out of the park. Somehow or another, they just blow it out of the water tomorrow on earnings. Where could you buy? You don't necessarily need to buy 47.78. You could probably buy a little bit. I would probably say your first area you could look to buy is probably in this area right over here. This would be aggressive. This would be an aggressive buy above here. Your better buy is probably up here. Why? Because these are your two. You have recent highs over here that we held. You could say we double topped over here. It's quasi, it's not enough time, but you could make that argument. Again, it's aggressive. Your better bet that tells you got clear skies is a break of this. Because then you got double top one, double top two, so to speak. And then, you'll be looking ultimately for a gap fill. That would probably be what you'd be aiming for. I didn't bring this up, but one of the things that's very important, and it applies to stocks, futures, options, whatever. It's very important that you always keep a positive risk reward. Many traders do what's called negative risk reward. So they'll risk, let's just say, I'm going to bring this up a second. My little cheat sheet over here. Okay, I'm going to bring this up here a second. Okay, I'm going to make this bigger. Okay, they'll do this. Okay, they'll risk $1. And what they'll do is, instead of making $1, Instead, they'll risk $1, and as soon as the trade is up 35 cents, they're out. So they risked $1 and they made 35 cents and they're gone. Or you'll get a situation where they'll risk $1 and as soon as they're up 50 cents, they're out. They're history. And they consider that a good trade. That is not a good trade. That is not good risk reward. That's called negative risk reward. Why? Because you're risking $1 to make 50 cents. So you're negative 2 to 1. That doesn't make any sense. If you're going to risk $1, at a minimum, you want to get $1, at least 1 to 1. And if you're doing for multi-day, then obviously you want to make $2 or $3 or $4, etc. But that would be 2 to 1, 3 to 1, 4 to 1. You don't want to be in a situation where you're risking $1 and making 25 cents, 50 cents, 75 cents. This is a big fat no-no. This is a big uh-oh that you're doing something wrong. Don't fall into this trap. This happens when you don't have a plan, when you're not confident in what you're doing, or you're not confident in the instrument that you're putting on. It's crucial, and it's always important to always think in the back of your mind, if I'm risking $1, I got to make, at a minimum, $1. It's got to be a 1 to 1 at a minimum. 1 to 1 is really like the bare bones minimum. But if you're getting in, you want to be making 2 to 1, 3 to 1, 4 to 1. But you cannot be going in, I'm risking $1 and I'm only making 25 cents, 50 cents, 75 cents. Now, obviously, certain times things can happen and you'll have negative risk reward trades. That's the nature of the beast. But if you're getting in with the mentality of I'm risking $1, and as soon as you're up 25 cents, you take it off, that is a recipe for disaster. Why? You will potentially have a very high win rate, but at the end of the day, you're not going to really be making money. Because if you're risking $1 and you're only making 25 cents, and you do that 4 times, you make $1. Okay, great. It takes one trade, you wiped everything out. One trade where you risk that $1 and you lose that $1 and it's all gone. So win rates, in my opinion, are just a complete and giant waste of time. People sit there and they always talk about win rates like it's some kind of magic metric that means something. It doesn't mean anything, because most of the time the people who have very high win rates usually have negative risk reward trades. So it just takes 1 or 2, and then anything that they were doing is basically wiped out. Really, tonight was really just to get you prepared for how to approach earnings. Another thing that's also important, by the way, know who's reporting and when. So, for example, tomorrow, Bank of America, Goldman, Johnson & Johnson, Morgan Stanley, PNC, all report tomorrow morning before the bell. They're all important companies, okay? So you know right off the bat that there's some important people reporting tomorrow. After the bell, you get United Airlines, which is okay. Kinder Morgan, if you trade in the natural gas space, Kinder Morgan is a very important company. So my fellas, take a look at it. Okay, Kinder Morgan, Cheniere, those are more important companies. So if we look out here at KMI and we say to ourselves, okay, what could the market do? The market's expecting 81 cents. The stock has really been doing nothing. This actually could go somewhere because the stock's been basically dead money. And maybe this earnings season could potentially ignite something in this. So that's something I would watch. Again, I went over the whole play, so I'm not going to sit here and start drawing and boring you with this, but just give you ideas of how to look at things and approach it. On Thursday before the bell, again, there are also very important companies. Travelers, very big in the insurance space. PepsiCo, obviously. U.S. Bancorp. You have Webster Bank, which is more of a regional bank. After the close on Thursday, Netflix. We all know how much I love Netflix. That's a huge one. That's really the biggest one for Thursday after the bell. Friday before the open, we have 3M, American Express. American Express will give insights 100% on how the affluent customer is doing. That one's going to be watched very heavily. So you need to know who's reporting and when. Why? Because it will allow you, number one, to not be in a stock that you have no clue what's going on and get caught in something. And if you're trying to swing trades, don't start looking at your technicals and you say, okay, let's just say Netflix is setting up. I'll just use Netflix, for example. Netflix is setting up and it takes out this high over here. Okay, I'm going to buy it. And you buy it ahead of earnings, not realizing that earnings are coming. And then you hold it. And then the next thing you know, the next day you come in and the stock's down here. Like, how did I just lose $100 in the stock? What the hell just happened? So be aware of what's going on. There's plenty of places and plenty of resources you can use to know who's coming and who's reporting when and why. Okay. So the three ways to do it is number one, you have the expected market maker move or the expected option moves. Okay. You have some technical breaks on breakouts that you could look for. And then you have moving averages. Okay. Those are the three ways you could look at it. I'm going to end off with two pieces of advice. Advice number one, when in doubt, stay out. If you don't understand what's going on and you don't understand why something's moving the way it's moving, just stay away from it. Stay out. Number two, if a stock gets clobbered for whatever reason, let's just say Netflix, for whatever reason, gets annihilated and the stock ends up down here. Okay. On huge moves, a stock, usually the day that it reports or the night after, the night before, and that opens up the next day, it's usually dead money. The adage is usually wait 3 days before you do anything. Let people digest. Don't be in a rush. You don't have to be the first one in the pool. Okay. These are binary events. And what I mean by that is these could change the complete and total perception of what investors think of a stock. If the earnings are amazing or if the earnings are terrible. So a lot of things can be going on. Technical traders only look at technicals. That's all they look at. Earnings season is the one time where what rules the day is 100% fundamental data without a question. So just be aware of it. Companies that you like, if you want to get more familiar with what goes on, read the transcripts. Listen to the conference call. See what they say. You may not understand anything that these guys are saying, which is fine because you may not know the business, but it starts to get you to think a little bit about of it as a business, as opposed to just a ticker. They're not tickers. They're not lotto tickets. They're companies. So it will allow you to just get in more in the mindset of the investors that are buying it, whether it be pension funds, whether it be hedge funds, whether it be mutual funds, whether it be sophisticated investors, that's the sophisticated investor class, family offices, etc. They're investing in the business. They're not buying stock just because of stock appreciation. They're investing in a business. So listening to the calls and reading the transcripts and looking at the presentations, and you can get them all on every website. Every company website, you can go into investor relations. You can see the materials that were presented. You could hear the conference call. You can read the transcript. You have all this information available to you. You could go into Edgar Online and you could pick up the 10Ks and the 10Qs, and you could see what was actually reported to the SEC, because the presentation and what's reported to the government is a little bit different, because what's reported to the SEC is 100% audited. Presentations are not always 100% audited. Sometimes they're unaudited because, again, it's an investor presentation. Whereas what's reported to the SEC has to follow certain guidelines like Sarbanes-Oxley, it has GAAP. There's a lot of rules and regulations that govern how these reports are put together. I hope this helped. This was really just a way to give you a little bit of a different perspective and to get you to think a little bit differently about earnings. I hope you enjoyed it, and I'll see you on the next one. Take care and have a great night.